Red Cat Holdings, ticker RCAT, has emerged as a highly speculative company in the rapidly growing defense and autonomous systems industry. The investment story is centered on the company's ability to scale its drone and robotic platforms, win larger government and international contracts, improve manufacturing margins, and eventually turn rapid revenue growth into sustainable profitability. In this video, we'll analyze RCAT's business model, recent financial performance, balance sheet, growth opportunity, valuation, risks, and potential 2026 to 2027 price targets. Red Cat's latest Q2 2026 results show just how quickly the company is growing, but they also reveal why this remains a high-risk investment. Red Cat is positioning itself as an all-domain autonomous technology company serving defense and national security markets. Its portfolio is expanding beyond small unmanned aircraft into broader air, maritime, and robotic systems. The company's strategy is important because defense customers increasingly want integrated autonomous capabilities rather than isolated hardware products. Red Cat is therefore trying to build a platform business around drones, robotics, software, and autonomous systems. The long-term opportunity could be substantial if the company successfully converts pilot programs and contracts into repeatable, large-scale production. The most impressive part of the RCAT story is its revenue acceleration. In Q2 2026, Red Cat generated approximately $20.19 million of revenue, representing roughly 527% year-over-year growth. This followed Q1 revenue of approximately $15.5 million, which was already up 849% year-over-year. For comparison, full year 2025 revenue was approximately $40.73 million. This means RCAT is transitioning from a very small revenue base toward a much larger commercial operation at an extremely rapid pace. Management has reaffirmed its full year 2026 revenue guidance of $150 million to $180 million. This is one of the most important numbers for investors because it implies a massive increase from 2025 revenue. If Red Cat reaches the midpoint of its guidance, the company would generate approximately $165 million of revenue in 2026. The challenge is that the company still needs to execute on production, deliveries, contracts, and customer demand during the second half of the year. Therefore, the next several quarters will be critical for determining whether the current growth trajectory is sustainable. Revenue growth alone is not enough. Investors need to know whether Red Cat can make money from those sales. The encouraging development is that gross margin has been improving. Q1 2026 gross margin was 12.7%, compared with negative 52.1% in the prior year quarter. In Q2, gross margin improved further to 16.1%. Management attributed the improvement partly to higher production volumes and better absorption of manufacturing overhead. This is an important early sign that scale could eventually improve the company's economics. However, a 16.1% gross margin is still relatively low for a company that needs to cover significant research, development, sales, administrative, and manufacturing expenses. This is where the investment case becomes much more speculative. Despite enormous revenue growth, Red Cat remains deeply unprofitable. Q2 2026 net loss was approximately $35.26 million, while diluted loss per share was approximately $0.26. Operating expenses also remained very high. So the company is currently demonstrating growth much faster than profitability. For the bull case to become sustainable, Red Cat eventually needs to combine higher revenue with substantially better gross margins and operating leverage. Until that happens, investors should treat RCAT primarily as a high-growth, high-risk company, rather than an established, profitable defense business. The balance sheet provides an important cushion. Red Cat ended Q2 with approximately $325.6 million in cash, compared with approximately $167.9 million at the end of 2025. This gives the company substantial financial resources to expand manufacturing capacity, invest in technology, pursue strategic opportunities, and support working capital. However, investors should not simply look at the cash balance without considering cash burn. Red Cat remains loss-making, so the important question is how efficiently management can convert this capital into revenue growth and eventually positive cash flow. The major financial risk is that rapid expansion can consume significant amounts of capital. Red Cat has been investing heavily in inventory, manufacturing capabilities, acquisitions, and operating infrastructure. The company's substantial cash position reduces near-term financial pressure, but it does not eliminate dilution risk. If operating losses remain large and expansion requires additional capital, shareholders could eventually face additional share issuance. Therefore, investors should monitor free cash flow, operating cash flow, inventory growth, and the number of shares outstanding, not just revenue growth. The broader industry opportunity is one of the strongest arguments for owning RCAT. Governments around the world are increasingly interested in autonomous systems, unmanned aircraft, robotics, and lower-cost technology. Red Cat is attempting to position itself within this structural trend. Its strategy of expanding from drones toward broader autonomous systems could increase its total addressable market if successfully executed. The key question is whether Red Cat can become a meaningful long-term supplier rather than simply benefiting from temporary demand spikes. Another interesting part of the story is Blue Ops and its maritime autonomous systems. The Variant 7 uncrewed surface vessel has advanced with the integration of a Volvo Penta D4320 diesel engine and DPI drive. This demonstrates Red Cat's ambition to expand beyond airborne systems into maritime autonomy. If this business eventually generates meaningful orders, it could diversify Red Cat's revenue base. However, investors should remember that technological progress is not the same as commercial success. Large production contracts and recurring revenue will ultimately determine the financial value of this division. RCAT operates in a competitive industry. Larger defense companies have significantly greater financial resources, manufacturing capacity, government relationships, and established infrastructure. Red Cat's potential advantage is its smaller size and focus on rapidly developing autonomous systems. If the company can innovate faster and secure contracts before larger competitors dominate emerging niches, it could carve out a valuable position. But the competitive environment means investors should not assume that strong industry growth automatically translates into strong long-term market share for RCAT. Valuation is one of the biggest concerns. RCAT's market value has increased dramatically relative to its historical revenue base, meaning investors are already pricing in substantial future growth. When a company is valued primarily on future revenue rather than current earnings or free cash flow, expectations become extremely important. If revenue guidance is raised and margins improve, the valuation could potentially be supported. But if growth slows or contracts are delayed, the market could apply a much lower revenue multiple. This makes RCAT significantly more volatile than a mature, profitable company. For my base case model, I would focus on whether Red Cat can reach approximately $150 million to $180 million of revenue in 2026 and then continue growing meaningfully through 2027. A reasonable bullish trajectory would involve continued government and international demand, increasing production capacity, improving gross margins, and successful expansion into additional autonomous platforms. However, because the company is still early in its development, I would avoid treating long-term revenue estimates as guaranteed outcomes. The next 4 quarters of actual revenue growth are much more important than extremely optimistic forecasts several years into the future. In the bull case, Red Cat successfully executes its 2026 guidance, wins additional large defense contracts, scales production efficiently, and pushes gross margins materially higher. Revenue could continue growing rapidly into 2027, while operating expenses grow more slowly than sales. Under this scenario, investors could begin valuing RCAT less like a small, speculative drone company, and more like a rapidly growing defense technology platform that could support a significantly higher valuation multiple and potentially push the stock into the $22 to $30 range in a strong 2027 scenario. My base case assumes strong revenue growth continues, but profitability improves more slowly. Red Cat reaches its 2026 guidance range, continues expanding its customer base, and gradually improves gross margins. while losses remain substantial during the transition. Under this scenario, I would place a reasonable 2027 valuation range around $14 to $20 per share. This is not a guarantee or a precise forecast. It represents a scenario based on continued execution and a valuation that remains supportive of high-growth defense technology companies. The bear case is also important. If government contracts take longer to convert into revenue, production ramps are slower than expected, gross margins remain weak, or operating expenses continue rising rapidly, investors could dramatically reduce the valuation multiple. In that scenario, the stock could fall toward approximately $5 to $7. The biggest danger is not necessarily that the company stops growing, but that it grows more slowly than the market currently expects. For a high expectation stock, disappointing growth can produce a very large valuation correction. The biggest potential catalysts are new defense contracts, larger production orders, successful Black Widow deployments, improving manufacturing efficiency, stronger gross margins, progress in maritime autonomy, and revenue growth above management guidance. Another major catalyst would be evidence that the company is moving toward positive operating cash flow. If investors start seeing strong revenue growth combined with improving margins and declining cash burn, the market could begin assigning a higher quality multiple to the company. The major risks include continued net losses, high operating expenses, cash burn, potential shareholder dilution, contract delays, customer concentration, manufacturing challenges, competition, acquisition integration risk, and extremely high valuation expectations. There is also execution risk because RCAT is attempting to scale very rapidly. A company can have excellent technology and still struggle financially if manufacturing, supply chains, pricing, or customer conversion do not develop as expected. My overall rating for RCAT is speculative buy, high risk. The company has several attractive characteristics: extraordinary recent revenue growth, improving gross margins, a large cash balance, exposure to the expanding autonomous defense market, and multiple potential growth platforms. But the weaknesses are equally important: large losses, significant cash consumption, uncertain long-term margins, and a valuation that already assumes considerable future success. Therefore, RCAT should be viewed as a speculative growth investment rather than a traditional fundamentally proven defense stock. For my 2027 scenario framework, the bear case is $5 to $7, the conservative case is $8 to $12, the base case is $14 to $20, the bull case is $22 to $30, and an extreme bull case could reach $35 or higher if RCAT becomes a major autonomous defense platform and substantially improves profitability. My base case target is therefore $14 to $20, but the range is intentionally wide because RCAT's valuation and earnings power are still developing. So, is RCAT worth watching? Absolutely. RCAT has one of the more aggressive growth stories in the autonomous defense space, and its latest financial results demonstrate that the business is scaling rapidly. But investors should not confuse explosive revenue growth with a proven profitable business. The next stage of the story is about quality of growth: higher margins, better cash flow, larger contracts, repeat customers, and operating leverage. If RCAT delivers on those areas, the upside could be significant. If it fails to meet expectations, the downside could also be substantial. Overall, RCAT is a high-risk, high-reward stock built around a potentially important long-term theme: autonomous systems and defense technology. The company has made impressive progress in revenue growth, but the real test begins now. Investors should closely watch the next quarterly results, especially revenue, gross margin, operating expenses, cash burn, contract wins, and management's full-year guidance. If those metrics continue improving together, the RCAT bull thesis becomes much stronger. But until profitability and cash flow visibility improve, this remains a speculative investment that requires careful risk management.